So after interviewing hundreds of investors worth millions and millions of dollars and reviewing thousands of rental properties in people's portfolios, I am convinced the number one wealth building technique you need to focus on is return on equity. This video is all about a step-by-step process for understanding and analyzing the equity in your current rental portfolio. And YouTube, I hear you. I'm going to analyze a property in today's numbers, today's markets at 8% interest rate. So step one is we're going to analyze the property itself. Step two is we're going to get the opportunity cost for what you can do with the equity in the property. And while I break this down, I'll share 5 tips I've learned over the years. This video is brought to you by Property Llama. Property Llama is software that helps you analyze your rental portfolio and maximize your return on equity. You see, I built countless spreadsheets, which was great for me and my clients, but quickly became a nightmare to manage all those files. And that is exactly why we built Property Llama. I needed a better way. My clients need a better way to go out there and understand how to evaluate their rental properties. So go to propertyllama.com/BP, create a free account, upload your properties, and get a free analysis on how your portfolio is performing. Plus, as a bonus, I'm gonna give you a free video report on my predictions and my portfolio moves and why I'm liquidating 50% of my portfolio. Go to propertyllama.com/BP. All right, let's jump into it. Now, we're actually looking at the Property Llama dashboard with a rental property with one of my current clients. So his name is Matt, and he purchased this property in January 2012 for about $125,000. So just over 10 years ago, he purchased this property. Now, I'll give you the mindset. He is a musician turned real estate millionaire. So he got into real estate because he realized drumming was not going to provide for him and his family. So he started with $25,000 and a lot of sweat equity. He did flips. He went out there and bought some rentals. He syndicated some deals. He's just busted his butt. And he's taken that $25,000 with lots of sweat equity and now turned that into a multi-million-dollar real estate portfolio. So congratulations, Matt. But now he's at the next phase of his property. He's owned this for a while. Now he's wondering, hey, what's the next move I make in my portfolio? You see, Matt's a savvy investor. So let's jump into analyzing the property. So something that's very important is you want to get in today's data, today's numbers into the system. So it's now currently worth about $480,000 here in Denver, Colorado. Now there's a lot of facts and numbers on this dashboard, but the very first place my eyes go to is return on equity. And it's showing it's a 7.75% return on equity. And that's taking the 4 ways you make money in real estate: appreciation, debt pay down, cash flow, and depreciation or tax benefits, and saying, hey, for the next 12 months, we should make about $24,000 in total. $24,000 divided by $312,000 is 7.75% return on equity. Now, what this is showing is how hard your equity, your money in your rental property, how hard it's working for you, how much money it's making for you. So it's making about 8% on Matt's equity in here. And when he analyzed this, his reaction was, that's kind of like what I can make in the stock market. And if I'm making about the same in the stock market, I'd rather not have the headaches of dealing with a property, of having to self-manage it, and the liability of tenants and toilets and all that stuff. So at an 8%, he wants to make a higher return on real estate, which is very common for the majority of real estate investors. If we're going to take on more risk, more time, and a more active role, we want to make a double-digit or greater return. Now, if you want more details on how return on equity is calculated and the long-term wealth building components of it, check out our other video on BiggerPockets that walks you through it. This is the how-to video. Now, the next number I look at is loan to value, or LTV, and Matt's is about 35%. This is saying how much leverage does he have on the property. Now, a key piece of making money in real estate is leverage. And generally speaking, the higher leverage you have, the greater return you'll make. So having a low LTV is very common when we see a low return on equity. Why? Well, because it's not a leveraged property. The next number I look at is cash on cash. I follow this green line here. So cash on cash, well, it shows blank. Why? Well, it's because Matt bought this for $125,000, but now he's a loan balance of $168,000 on here. What happened? Well, years ago, he did a cash out refinance and he took some equity and reinvested it. So essentially, he did a long-term BRRRR on this property where he has none of his money in the property. So therefore, there's no cash on cash since he has no cash in the property. Now, cash on cash is a really good metric for analyzing a property when you buy, but not analyzing it as a current rental. The better way to look at it is, what's my cash on equity? So he's making about $6,000 a year, which is about a 1.8% return on his equity. So for all the equity he has in the property, he's making 1.8% in cash flow. Has anyone else noticed the headlines of what CDs and bonds are paying right now? They're paying a heck of a lot more than 1.8%. So if Matt wanted more cash flow, he could simply invest in a CD. So this brings us to tip number 1, and that's that traditional long-term rentals are usually poor vehicles for cash flow. My eyes go to cap rate next. Now, I like cap rate because it shows how the property is performing in today's numbers and today's rents. Now, if you're familiar with cap rates, you do not get excited over a 3.1% cap rate. Without going to another 20-minute video, that's a low cap rate, which usually means it's time to sell. But this brings us to tip number 2, and that's asking yourself, would you buy this property in today's numbers? Now, one side of the coin is the numbers, and the numbers say, no, this is not a good rental. The other side of the coin is what you know about the property from an operational and an emotional standpoint. Some properties take a lot to operate or they're a heavy emotional toll. And so you have to evaluate those two aspects of the property, the numbers and from the operational standpoint. So in Matt's case, his answer is no and no. So step 1 of analyzing the rental property is complete. Now we move to step 2, which is determining what opportunities you have with the equity in your property to potentially go out there and reinvest it. Now this brings us to tip number 3, and that's determining what your goals are. Are you in growth mode or income mode? Because you need to make sure that any moves you make are aligned with your personal goals as an investor. How do you know which mode you're in? Let me ask you this. If you stopped everything you're doing today and paid off all your rental properties, would you have enough cash flow to retire? If you do, then you have the option to get out of growth mode. If you don't, well, then you're still in growth mode and you go out there and accumulate more assets. So let's jump into option number 1, and that's keeping the property. Now, the main area I look at on this scenario is what happens if I pay off the property? And that's actually looking at the NOI, or net operating income. That's all the expenses of the property, but no debt. So currently, if Matt paid off today, he'd be making about $15,000 a year. Well, $15,000 over $300,000 plus in equity is about a 4.8% return. So in today's environment, 4.8% cash flow is not a great return. Now, in addition to poor numbers, Matt's not ecstatic about keeping the property or managing it. Now, there is room to raise the rents on here. He's a long-term tenant here, but it would take a $30,000 to $50,000 remodel to raise the rents. Plus, he's self-managing it. So the numbers aren't exciting, and Matt's not excited about the property. So let's jump into scenario number 2 of refinancing the property and then pulling money out to go buy a new property. So I'm putting in an interest rate of 8%, a cap rate of 6%, and we're gonna leave 35% equity in the current property and put down a 35% down payment in the new property. So now we have a side-by-side comparison of how this property is going to perform. So the current property is on the right, and it's going from a 7.75% return equity to a 7.6%. So it's going down slightly. But here's the biggest difference. Look at cash flow. Cash flow is from going from about $6,000 to about a negative $11,000 a year. Oh my goodness, what is happening? Well, that's what happens when you have loans at 8%. So the loan on the current property is going to be at 8%. And you see, once he takes out that new loan, it's going to be negative cash flowing $1,000 a month. And the new property he's buying at an 8% interest rate will be cash flowing about $100 a month. So not a great move from a cash flow perspective. Now, tip number 4 is a really important one for so many landlords out there. And that is, don't get married to your low interest rate. Matt, like many of you, has a fixed long-term 30-year note on here at about 3.65% interest rate. That is an awesome debt to have on the property. But keep in mind, that is just one aspect you're looking at when you're analyzing the property. Don't just look at that metric and look at nothing else. You have to look at it as a whole. Look at the low interest rate, look at return equity, look at the cash flow, compare it to if you're in growth or income. So don't get hyper focused on there, because if you just look at that, while you're saving money there, you're giving up a lot of wealth creation potentially in another investment. So let's look at scenario number 3, which is sell your property and buy a new property. So most people sell a property and utilize a 1031 exchange to minimize taxes. Now I'm putting in numbers that we're seeing in today's market at a 35% down payment. Comparing the numbers on here, return equity is going up from a 7.75 to almost a 13%. So a decent jump there. But look at cash flow. We're going from almost $6,000 in cash flow to about $2,500 in cash flow. So a big step down in cash flow. A good win is that we're going from 15,000 NOI to 53,000 NOI. But here's a problem. Where Matt is in his portfolio, where he needs growth, these numbers with 1031 exchange just don't cut it. Which brings us to tip number 5. Don't get 1031 derangement syndrome. You see, 1031s are an amazing way to go out there and defer capital gains. But what people do is they get themselves boxed in and they say, oh my gosh, all I can do is a 1031. So they often end up making no decision, or they sell and buy into a subpar investment. Now, actually take a step back and look at potentially paying capital gains and not doing 1031. A lot of times the options are way better. So after going through all 3 scenarios and comparing them side by side, Matt and I looked at each other and were like, yeah, there's no great option here. There's nothing exciting going on. So what's Matt to do? So this is why it's so important to look at your goals as an investor, but also take a step back and look at the macro trends in real estate. Remember, Matt started investing in 2007 with $25,000. With that money and sweat equity, he became a real estate millionaire. And he did that by focusing on trends. He rode that big appreciation trend after the 2008 crash. So Matt knows trends and wants to ride the next big trend as well. So after reviewing Matt's goals and looking at the trends, Matt determined his best move was selling his rental property, paying capital gains, and investing that into an apartment syndication, doing passive investing. You see, Matt made a lot of his money by burring rental properties, and now he's on the next big trend, which will be burring apartment buildings as those prices drop. So on the left-hand side here, we have this current rental showing the 7.75% return equity. Now in the new investment, he should be making around a 23% return on equity. So almost a 3x increase to return on equity. Now, those are the types of return equities we saw back in the 2010s when people were doing 1031 trade-ups and cash out refinances. Those are the numbers as real estate investors that we want to see. Now, in addition to a higher return equity, he's going from about $6,000 a year in cash flow to almost $11,000 a year in cash flow. So he's almost doubling his cash flow here. Now, there's a very important thing to talk about here. He's selling this property and he's investing passively, which typically do not allow 1031 exchanges. So we have taken off about 20% in transaction costs and some capital gains to show the investment here. But keep in mind, this is one of the exciting things about real estate. Even though you can't 1031, there are different solutions out there to help offset the capital gains. So Matt is kind of gone from working harder to now working smarter since he has more capital to deploy. Congratulations, you just learned how to analyze your rental property and figure out the equity opportunity cost you have. Now, since you did that once, go do it for your next property, and your next property. And this leads me to tip number 6 here. When do you go on there and analyze your rental property? It's anytime you're about to lease the property, refinance it, remodel it, or at an annual basis. Keep in mind, this is not a stock market fund that auto rebalances. You have to manually come in here and look at the property. So those are the 4 times when I go on there and look at my rental portfolio. Now, after Matt analyzed all the rental properties in his portfolio and his portfolio as whole, he made some big moves based on his personal goals, the performance of the properties, and the market conditions. And you can see here, this blue line is his current portfolio. In about 30 years, if he did nothing, he would achieve his goal of $120,000 a year. But it's going to take 30 years. Now, by going through this process and optimizing his return equity, he'll be able to achieve his goal in about 9 to 10 years. So massive wins for his portfolio. But the details behind that is a whole other video. So if you want to see it, let me know in the comments below. All right, fire hose is turned off. I know that's a lot of information to understand how to analyze your rental portfolio, but it's so important to understand. So here's my challenge to you. Go out there, analyze your rental portfolio. Go out there and understand what your return on equity is. And then we have started a new post in the BiggerPockets forum for us to come in here and discuss your portfolio moves and your questions. So analyze it, hop over to BiggerPockets forum, and let's chat in there.